there is a large industry, Wall Street, whose drumbeat is you too can be Warren Buffett, you too can pick stocks, you too can outperform the indexes. Only if you're willing to pay us for the privilege. And that's a very seductive message because everybody wants to think that they can be above average and outperform. One of the comments that makes my skin crawl is when I hear people say something like, well, Warren Buffett became a billionaire picking individual stocks. I'll just do what Warren did. As if. As if. There is a reason that Warren Buffett is famous, because Warren Buffett has managed to do something that is extraordinarily difficult to do.
Some people are not actually emotionally or psychologically fit to own stocks. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down.
The ability to do it is extraordinarily rare. And the hubris to think, oh, I'll just go and do what Warren has done is, to me, stunning. It's just absolutely stunning. And the research indicates that while Warren has done it, as we talked about, you go out 30 years and less than 1% of people trying to do it who have survived that long have accomplished it.
Stock picking has a terrible record, and it's getting even worse. 85% of large cap managers underperform their benchmark after 10 years, and 92% underperform after 15 years. That's a pretty poor long-term track records. But everybody always brings up Peter Lynch and Warren Buffett and their ability to outperform. There are a few superstar managers. What was their secret? Or is it now not possible to be a Warren Buffett anymore?
Yeah, they certainly had a secret sauce, and what has happened is the academics have basically reverse engineered it, trying to identify what their common traits or characteristics of stocks that these superstar investors, say from Graham and Doddsville, would buy. And they found out that they bought high quality stocks that also had relatively low PEs. Doesn't take anything away from their great success. They figured it out 50 years before the academics, but everyone can access these types of funds or stocks today.
There's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy.
You can't turn on the financial news or open up a financial periodical without finding somebody who's telling you definitively where the stock market is going next. Nobody knows. If you could accurately do that with any consistency, you'd be far richer than Warren Buffett and far more lionized. It would be magic dust. Nobody can tell you where the market is going. You just can't predict the market. And trying to is a fool's game.
No. Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if a stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real, right?
You can't get it by reading a magazine. You can't get it by watching television. You can't. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but that you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact.
I just kept believing that I could pick people who could pick stocks, and I believed that I could pick stocks. And because every now and again I'd get it right, and maybe I got it right more often than I got it wrong, that feeds into that belief, and that's the thing that made me reluctant to pick up indexing. But the truth is that the few times I got it wrong dragged down my performance to where, and this is what happens to the vast majority of people trying to do it, to where I would have been far better off with the index, far better off.
So, I think we take a lot for granted. We listen to all these theories, and big, old, boring indexing is the answer.
Have you ever bought individual stocks and or actively traded funds? And if so, what do you look for in those investments?
Well, when I came into the business, I had friends in the brokerage business. I bought this and that and the other thing. So I haven't owned an individual stock since, let me say, 1960. I don't know exactly, a long, long time. We have a gambling culture here in this country. Maybe every country does. You see it in its finest manifestation, or maybe I should say worst manifestation, in the lottery, state lottery. Las Vegas contributes its share, and all these are just gambling, where a whole lot of people bet their money, and a whole lot of people take their money out, and the croupier wins. I'd say have a funny if you have the gambling instinct, and most people do. At least start off. I'd say start off with an index fund, period, and for 5 years don't do anything else.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Now, the irony is, if you invest in index funds, and of course the slam that active managers put against index investing is that you will only get average returns. That's a little bit misleading, because yes, the index gives you the return of the market overall, but that return is far above average. Index investing, based on the research that has been done, outperforms, depending on what numbers you look at, 80 to 85% of active managers over a 15-year period of time. If you research out 30 years, the number of active managers who can outperform the index is less than 1%. That's statistically zero. So when you invest in the index and you're getting the average performance of the market, you're actually getting the best performance that you can expect by a long shot.
Another issue, of course, that's happened in the world of stock picking, where all this money and effort goes into trying to be rational, is that we've had a really horrible thing happen to the investment counseling class. And that is, these index funds have come along and they basically beat everybody. So you have a whole profession is basically being paid for accomplishing practically nothing. This is very peculiar. How is that profession handling this terrible situation as index investing gets more and more popular, and including by a lot of fancy places? I'll give you a very simple answer. They're handling it with denial. They have a horrible problem they can't fix, so they just treated as non-existent. This is a very stupid way to handle a problem.